Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host, Steve Savant, syndicated financial columnist and money gamer extraordinaire. Today we're talking about why should a business consider creating a captive insurance company with author and captive insurance expert, Wes Sirk. Welcome to the show, Wes.
Thanks for having me.
Well, I have to say, this is a very interesting concept. A lot of our consumers are also business owners. Some small, 50 and under employees. Some of our listeners, we're up 200, 300 employees. And when I hear you talk about some of the advantages of buying wholesale rather than retail, right there I hear the cash registers ringing in a consumer and a business owner's mind, because we just don't want to pay, retail if there's a way to do it, and nobody wants to write an insurance premium check. So if I have liability like workman's comp, or health insurance, things of this nature, and if I'm writing big checks, there might be a way to mitigate that cost and get a deduction and participate in the savings if I don't have claims. Talk about the beauty of captive insurance companies.
A captive is an insurance company that a business creates to insure its own risk. So businesses already are paying workers' comp, health insurance, liability, and many of the business owners, they can't remember the last time the insurance company paid out more money in claims than they paid in premiums. So if that's their situation, they may look at forming their own domestically licensed insurance company to insure the risks of their business. So they're like AIG, Zurich, Liberties of the world. They're their own insurance company. They can now pay insurance premiums to their company, and just like traditional insurance companies, they can go and get reinsurance to lay off some of their liability. So in the event they had that catastrophic event, that another reinsurer is going to take a lot of that liability for them.
Okay, so really, in fact, they're starting a new company. It's going to be an insurance company that they actually have to file with the state.
Correct.
Just like any other insurance company. They're now, instead of buying strictly retail to the AIGs of the world, as you said, they're now going to the backup or these reinsurance companies, and they're buying at the wholesale level to protect themselves, and that savings could be substantial right there.
Yes.
But talk about the deduction now, because there's the deduction. I hear a lot of business owners say, oh, I'll just self-insure. But what's the difference between a captive insurance from a deduction point of view and a self-insurance from a deductible point of view?
If a business self-insures, they only get a deduction for the claims that they pay and expenses they have. If they're a captive insurance company, then they get a deduction for all of the premiums that they pay to their insurance company. And then when they pay the claims out, then they're left with the underwriting profit. Most of our businesses, it's kind of counterintuitive, but most of our businesses don't save money in insurance premiums because many of the businesses are pass-through. So let's say that they were paying $2 million a year before they created a captive. Well, the underwriting profit was going to the insurance companies. If right now their claims were $750,000 and they just put $750,000 in their captive instead of $2 million, then they have an extra $1.25 million that they then have to pay taxes on. So by paying the $2 million to their own insurance company, still paying out claims, they now have money inside their insurance company, which they're paying taxes on their investment earnings, but they have the ability to take the money out of the captive for long-term dividend rates if the captive's still working, or they do a complete liquidation of their corporation, of their captive, and they pay capital gains. So there's much more tax advantages for doing a captive insurance company.
I've heard that when I have a tax, so I'm actually funding my insurance company that I just created. I filed with the state, so I'm okay there. And I'm watching the actual legality issues that I have to watch for the IRS. There's a lot of issues there, and you're an expert in that. When I go ahead and set up my captive and I'm paying my claims out of there, if I don't have any claims, I had earnings, I could actually take that out. Now I have to pay tax on that.
Correct.
But when I'm looking at this, there's several different
dividend rates.
And dividend rates.
At dividend rates versus ordinary income. A business owner that passes an extra $1 million to themselves through their business, depending on their status, could pay 50% of that to the government. But if they were to take it out in a qualified dividend from their insurance company, then they're taxed at 20%.
So that's a huge issue, even on the portfolio management within the captive.
Correct.
Okay, now there's so many different captives. I mean, I've heard you talk about it in the global, and we just did a general explanation. When I come back from the break, I wanted you to break out some of the different versions of this because we have different audience watching us, and one of these might be something that they might find as a real appreciative issue to set up their own captive. But what kind? We'll come right after the break and talk to them about it.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back to our second segment. Of course, we're with captive insurance company expert, Wes Sirk. Wes, we're talking about, I don't want to pay retail, I want to pay wholesale. I'm talking about getting a full deduction, and not only deductions on the kind of claims I actually incur. But a lot of this, you talk about this in your book. You wrote a couple books. This first one came out in 2008, Taking Captive, and the most recent book you have is You Can Make It, But Can You Keep It? Give me a little idea of what each book has so that our business owners can say, hey, I might want to pick this up at Amazon.com.
Taking Captive is about captive insurance companies, how they work, why they work, and the things you need to not only the things to look for, but also to watch out for. You Can Make It, But Can You Keep It is just strictly about the things that can take wealth away from business owners. So it's really 4 sections: entity structures, asset protection, estate planning, and then finally, we don't touch money. We're not we're not asset managers, but we spend time on asset allocation and just what I do personally.
Well, let's talk about some of the basic differences of a captive company. Big companies will start their own company, they do that. But there's some people saying, I'm not that big. Is there anybody out there that's like me that I can share with?
Yeah, and that's a specific marketplace. They have group captives, they have an association captives, they have risk retention groups, and that's where people come together.
So like if I'm in a construction company and I go in with other construction companies and we're in a group captive.
That's an example.
Okay, and then talk to me about this idea. I've heard you mention this before in some of your speaks. You're leasing your captive.
The rent-a-captive.
You're rent-a-captive, yeah.
That's where large insurance companies, AIG, Zurich, Liberties, they set up a captive insurance company, and then they give all of the captive owners their own little cell within the captive insurance company.
So the insurance company's still involved, but they're now do you see people kind of want to dip their toe in? They'll say, I think I'm going to lease a captive first, see how it goes, before I actually create my own.
We do see that. Now, unfortunately, insurance companies aren't in the business of losing money. So if you pay $300,000 in premium and you have $1 million in risk, there's always a difference between the premium and the risk. A lot of these rent-a-captive scenarios, they'll require you to post letters of credit and cash with them up to your full limit because they don't want $1 million claim. You put in $300,000, they have $1 million claim, and then suddenly they're paying out $700,000. So they collect money from you.
So I have group, I have rent-a-captive, and then of course create my own.
Correct.
Now, and you say if we're big enough, we're over 200 employees, we're writing $2, $3 million, $5 million in insurance premiums on an annual basis. We should be looking at this because this could be a huge way to be profitable against our own risk.
Correct. And the area that we work in is single parent captives. That's where a business creates a captive specifically for themselves, their business, and their employees. If they're in a rent-a-captive scenario or a group captive or an association, there isn't any incentive for them to overfund because if somebody else has bad claims, they could always come in and take some of their assets to pay their claims. So we only work with businesses that want to create their own company for their own risk and their own employees.
So when I'm thinking about a captive for my own company, I'm really not going to be sharing any other risks. It's just my own, and I get to control that. And there's a pretty good idea from a business point of view. I'm in control of my own company and its destiny.
Correct.
Well, when I'm looking at the numbers here, you see, I'm talking about there are so many captives out there. I think people say, Steve, I'm hearing this for the first time. Is it rare? Is it a little odd that most businesses that are watching us are saying, I never heard about this before?
It's really the nature of property casualty insurance. And Elliot Spitzer's had his personal problems. But, you know, I think he's the first guy that got it right as far as when he testified to the Senate in 2004 about the insurance industry. And he said that in his testimony that on a single transaction, a broker has the ability to make 6 commissions on the sale of one product, and only one of those are disclosed to the end consumer. And I think it's a sophisticated transaction to do a captive insurance company, and also it's the nature of the game. Captive insurance companies are large. I mean, it's approximately 50% of the global insurance market is in a captive or in alternative risk in one way, shape, or form. So it's actually huge. You look at the Fortune 1000 companies, virtually all of them have at least one, if not 2, if not 3 insurance companies. Verizon, FedEx, UPS, BP Oil, Exxon. I mean, it's huge, prevalent.
When you think about this could be an actual idea that you could use in your practice and in your business that could really put some more money in your bottom line and help you mitigate your own risk. Well, that's our show for today. I want to thank Wes Sirk for being my special guest and today's money mentor. And before moving forward with any of the ideas you hear on the show, always consult your tax advisor or your legal counsel. And remember, as the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. See you next week.